Welcome to FX Street. Again, my name is Adam Rosen. 8:32 a.m. Eastern. Very happy to be here. Ed Ponzi is the best, by the way. We used to work together about 100 years ago. At any rate, we have a lot to talk about. Before we get to the charts, which I certainly do want to get to, because we have a lot of fundamental and technical data to talk about, quick look at the FX Street calendar. Capacity utilization in Canada, 76% above the estimated, is that estimated or the prior, 75.5%. The previous was 74.4, the consensus 75.5, that came in above estimates at 76. Labor productivity came in a little bit below estimates. New motor vehicle sales 2.4% versus 1% expectation, better than expected. U.S. retail sales 0.44 versus a 0.3%, better than expected, in line with last month's numbers. And we have business inventories in the U.S. at 10 a.m. Eastern. So far, kind of looks like most of the numbers we've seen earlier today are good. However, prior to these 8:30 numbers, we did have some other numbers. We had UK, where is it on my chart? We had the retail price index. We had UK CPI, Consumer Price Index. That came in at 3.1%, in line with last month's number of 3.1%. Consensus, it says 2.9. I read another article that said 3%. Either way, a little bit better than expected, in line with the last number. But I think the really big piece of news so far today is the the German economic sentiment figure, also known as the ZEW. Last month, we had a reading of 14. Again, readings greater than 0 indicate positive indications, below 0 negative. Last month was 14. It was expected to decline to 10. It did not decline to 10. It declined to negative 4.3. So much worse than expected. Now, Bloomberg.com article cites this as in part being the result. In fact, let's go to the article really quick because they said it in a really nice way. Let me show you what they said. And then we'll get to a little bit more pertinent information. However, this is really quick snippets in the Bloomberg.com article. German investor confidence fell more than economists forecast to a 19-month low in September. They say because as budget cuts across the Euro region and slowing global growth clouded the outlook for Europe's largest economy. Again, last month it was 14. It was expected to drop down to 10. We dropped down to minus 4.3. Now it's a confidence index, so it's sort of, not sort of, it really does gauge the European consumer / investor as far as, so it's actually investor and analyst expectations, how they feel moving forward. And they said it's because of the budget cuts across the Euro region and slowing global growth. I don't necessarily think it's a very big number. It's important to watch, but if you saw this kind of decline in more of a concrete number, meaning CPI, PPI, GDP numbers, employment numbers, those literally count, the components of the economy. This asks European investors and European investors and analyst expectations. So again, because of the budget cuts, things might feel a little bit worse than they are. Nevertheless, I'm not trying to paint a rosy cloud on this because it really is not a good number. Long story short, I would expect a little bit of weakness in the euro currency, if not in the overall global sentiment. Now, we know the Dow Jones Industrial Average had a big day to the upside yesterday, almost 1%, closing up 81 points at 10,544. The S&P was up over 1%, the NASDAQ up almost 2%, Russell 2000 2.5% to the upside. A big day yesterday. If we did not follow the charts very closely, this probably would have felt like a breakout day, meaning that, wow, things are going up, and I think that things are going to continue to go up. But take a look at the Dow Jones Industrial Average chart. That big day yesterday, this is the symbol is YM, by the way. This is the future symbol. A little bit different than the cash market, a little bit ahead of the cash market. It stays very close. Despite yesterday's very big day to the upside, and I hate to be such a constant bear or pessimist on the market, but despite yesterday's rather big move to the upside, we didn't break out. Nothing really dramatic happened. We're at 10,469 on the futures right now. Yesterday the futures hit 10,545. Take a look at, I'll give it away, the first shoulder of a minor head and shoulders pattern Head and shoulders, again, it's a triple top or the center. The head is a little bit higher than the first or third head or top, meaning first or second shoulder. First shoulder high, and the rule of thumb, again, with head and shoulders, is that the first and second shoulders should come in very close together. First shoulder high came in at 10,531 on June 21st. Yesterday's highs, 10,545, 31 to 45, only 14 points difference in the futures. That is very, very close. It also represents the long-term 61.8% Fibonacci retracement level. If you draw the Fibonacci lines from the all-time, not all-time, but very, very big highs of 11,200, those are April 26 highs, by the way. Draw the Fibonacci levels all the way on down to those huge lows, going down to 95.02 on July 6th. And we see the Fibonacci levels, Fibonacci lines emerge. 61.8%, coincidentally, I don't really believe in coincidences in foreign exchange market. However, we see that both of these tops failed to break above the 61.8% Fibonacci retracement level. And in essence, unless we have a strong close above 10,600 just to round it out, this might be at least a short-term top. In addition to that, we have a long-term top, which is the second shoulder of a massive head and shoulders pattern, and that puts us just below 10,700. So 10,600, smaller possible resistance, big time resistance, 10,700. Now, if the Dow Jones is able to really break and close above 10,700, excuse me, I will then put away my bearish hat and start to become probably very bullish and optimistic about the Dow. And I think we can go a lot higher. But we first have to get above 10.6, and then we have to get above 10.7. The reason I'm bringing it up now is because those bears out there that think the Dow is going to go down, this does represent a really nice risk-reward ratio. After all, if you want to sell short, you want to try to sell short as high as possible because that gives us a better entry, better to sell high, and it puts us closer to the stop order, meaning less risk, more potential reward. True, we do have also an upside down head and shoulders with a head at the bottom, again, that 95.02 low going back to July 6th, and the neckline at the former 23.6% Fibonacci retracement level. Those lows arguably send down to 9,900, and then we have these lower lows at 9,750. So we have a range of possible support, 9,750 to 99, resistance from 10.6 to 10.7, and a trading range. Now, the head and shoulders typically break in the opposite direction of the head. We have a head at the top, we have a smaller head at the top, we have a head at the bottom. So, if anyone's guessed which way we're going to go, if I had to guess, with my eyes closed, I would guess we would probably break lower as opposed to higher. Fundamental data certainly is not good. The retail sales are a little better today. But fundamental data overall is not good. After all, GDP, which beat estimates, is only at 1.6%. We were at 5% plus in the U.S. beginning of the year. Non-farm payrolls, well, the unemployment rate is 9.6%. That's not good. We did have private sector job hiring, but public sector job losses overwhelmed those private job hirings. You know, we could go on and on. New home sales, pending home sales, etc. Numbers do not look good. We're coming into a very volatile time of the year. October earnings season. We know October tends not to be a very nice month sometimes in the stock market, such as 1987 in October or 2008 in October. Not to say October can't see up markets, but we know one thing, volatility will come back in October. And we have these congressional elections in the U.S. in November, and that is a huge question mark, and the markets overall do not like uncertainty. I would even venture a guess that because of the economic times that we're in right now, these congressional elections might have a stronger impact or should be more closely watched than the presidential elections of 2008. Now, we were in a very bad market, 2000 presidential elections 08, the inauguration 09, we had that huge move to the downside, but I think there's a lot more uncertainty in the market now because we have not recovered. 2001, tech bubble crashes. By 2002-ish, we had hit the bottom, 03, we were already at least consolidating, and the numbers had progressively started to look better. I'll show you the numbers, by the way, because I do promise to cover fundamental and technical data here. The fact of the matter is, it does not feel like 2001, 2003. Now, it did not feel good in those years either, but I don't know, maybe because we're living these markets right now, maybe it feels a little worse. Maybe I'm just a constant pessimist and bear. Nevertheless, I don't see a lot of reason for the market to go up, at least until we get through the congressional elections. And even if we do, when we do get through these elections, if the Republicans take control of the House and the Senate or both, what does that mean? That means that we may have a Congress that will veto everything that the president puts through, and the president will veto everything that the Congress puts through, and that really sort of doesn't get us anywhere either. So there's a huge, huge question mark. And no one is even talking about this yet so far, from what I've heard, we have holiday shopping season right around the corner. We know Apple will probably do well because they always make money. And everyone shops online, so Amazon.com will probably do well. Everybody has to ship all these gifts that they buy on Amazon.com. So Federal Express and UPS will probably do well. But those brick and mortar retailers out there, and a very large component of the economy is retail sales, consumer spending, and a very large part of that, a huge part of that, takes place during the holiday shopping season, the last 2 months of the year, last month of the year, 6 weeks or so. I cannot imagine that we would expect any extraordinarily strong holiday shopping season. A lot of big question marks out there. Combine that with October volatility, I would expect the market to eventually break out. That's why I say if I had to close my eyes, given the current fundamental situation, I would say I would probably guess to the downside. I hope I'm wrong. I hope things get better. They will. I hope they get better quickly though. Let's take a look really quick at some of this news. Then we're going to get to the charts. Okay, so first of all, let's take a look at the ZU number. The light baby blue line represents the ZU. Again, that's the German investor confidence figures. Analyst expectations are basically pulled, and it gives us an idea of what the investor expectations are in the Eurozone, dropping to negative or minus 4.3. The prior result was 14. But look to see where we were. We were at 56, October of 2009, September of 09, 57.7 September. We have dropped from 57 all the way down to minus 4.3. Moreover, the last time we were down here, we were looking at a level of March of 2009. That means in terms of investor expectations, things have not been this bad since March of 09, a year and a half. By the way, the dark blue line is the DAX, that's the stock market in Germany. CAC 40 is a green line, that's the stock market in France. And we can see, well, the ZU is a very cyclical type of number. So every time we go up and down, it does not, completely reflect what we're looking at in terms of the stock market. However, we can see during very prosperous times, take a look at the ZU. We're at 89.6 January of 2000. Take a look at the DAX, was at 7,600 back then. Then we dropped all the way down. The ZU dropped to a level of negative 63.9 July of 08. That was not a good day. And the DAX, the DAX dropped to negative 3.5. Oh, I'm sorry, the DAX, that's the ZU. The DAX dropped to 3,800. Point being is that we've seen such a move down, I certainly would expect more down movement as opposed to up movement in the equity markets in Europe. We can also obviously compare the ZU to the euro-dollar currency pair. Of course, there are two currencies within a pair, so it's not a completely fair comparison. However, there is, generally speaking, a correlation. The ZU, which is the violet line in this case, when that goes up, we tend to see the euro go up against the dollar, the euro go up against most currencies. When the ZU goes down, the euro tends to go down. Now, the dollar is also is the other component in the euro-dollar, so there were U.S. issues, economic issues at stake at that time. So that's why the chart will vary. However, generally speaking, good numbers in the ZU equals strength in the stock market, strength in the euro currency. We've seen some pretty poor numbers today. Going back, Bloomberg said 19 months. Would we expect the euro-dollar to go to 19-month lows? Well, even if we don't, we were in June of 2010, just a couple months ago, we were 122. Euro-dollar is a lot higher than that now. So we certainly would expect weakness to follow. Speaking of U.S. data, by the way, just to give you a quick snapshot of what we're looking at, this is just an unbelievably shocking chart, and I'll show you what I mean. This chart represents the U.S. GDP, gross domestic product. Again, it's released on a quarterly basis, but we do have monthly updates, the preliminary, the final, and the middle number. And the blue line represents the Dow Jones Industrial Average. There's a screaming head and shoulders on the Dow Jones Industrial Average. There's a head at the top. Take a look at where U.S. GDP was going back to 2000. Remember those days? 8% GDP. GDP in the worst market of 2001 went down to negative 1.3%. But we very quickly recovered. Now, let's see the bottom of the Dow. The Dow actually bottomed out 75.91 in September of 2002. The GDP had already started to improve. The Dow took some time to improve, but the GDP hit lows after hitting the top August of 2000, hit a bottom May of 01, less than a year, but very, very quickly, May of 2001 to May of 2002, GDP went from a negative number, negative 1.3, up to a positive number of 3.5%. More recently, we saw the Dow or the GDP really spill over to the downside, June of 09, negative 6.4%. Then we had a huge recovery, hitting the highs March of this year, 5.6%. We were 5.6% GDP in March of this year. Well, since then, the GDP has now fallen down to 1.6%, putting us back down at levels we've not seen since October of 09, and certainly heading to the downside. This is one of the reasons why I do not think that we're in a recovery quite yet. Again, we hit the bottoms of GDP in 2001 after hitting the top in 2000, and then very quickly recovered. The Dow hit bottoms of February 09, and the GDP the GDP has recovered since then, but we're heading back to the downside again. We need to see the gross domestic product recover. That's in terms of the U.S. And there are certainly 7 other currencies and 7 other respective economies that we should fairly discuss. But what happens in the U.S. is very copacetic to what happens in the rest of the world in terms of investor confidence. And I always like to say what's good for Australia is good for the country, or I should say what's good for Europe is good for Australia. We're all tied together. And when we really want to talk about the foreign exchange market, we want to talk about low yielding currencies versus high yielding currencies. Low yielding currencies, like the dollar, like the Japanese yen, and like the Swiss franc, are these currencies that we buy when we say, we're in trouble. Let's buy something that's safe, that they're not going to cut rates. Bank of Japan really can't cut rates because we're already at 0.1%. That's what we buy for safety. When things look good and we are really not satisfied making 0.1% interest in the Japanese yen, then we want to take a little more risk. Then we want to buy those higher yielding currencies. That could be an Aussie, a Kiwi, a CAD, a Euro, a Pound. You can say, well, the Euro and the Pound, they don't have high yields yet. However, there's a big question mark because one day we will see higher yields in the Eurozone. One day, I think before that, we will see higher yields in the UK. So it's not so much where yields are right now, where interest rates are right now, but moreover where they are now and what is the expectation moving forward. How soon will the Bank of England raise rates? According to today's data, it could be, I don't think it's going to be right around the corner. I don't think it'll be tomorrow, but it might be a lot sooner, I think, than the Eurozone. I think it'll be sooner than the U.S. as well. If I had to guess, don't hold me to it, but if I had to guess, I would guess the Bank of England is going to raise rates before the Eurozone and before the U.S. Today's numbers were the CPI numbers in the UK, Consumer Price Index, measures that basket of goods and services on a consumer level, came in at 3.1%, which matches July's number of 3.1%. We're already above its own 12-month moving average, though, and that's nice. We know the Bank of England so far has voted the past couple of meetings to keep rates unchanged. However, Andrew Sentence, he's my favorite guy from the Bank of England because he wants to raise rates. He says inflationary pressures deem that the Bank of England should raise rates. He's been outvoted so far. But again, his reasoning is inflation. Inflation for the past 2 months, consumer spending, so to speak, consumer prices, I should say, they represent the inflation, the level of inflation in the UK. 3.1%, 2 months in a row in the UK now. I would venture to say that we could see some nice strength in the pound if the next CPI meeting, if we're able to break above our former highs of 3.7%, those are highs at April of this year. Because if we break above 3.7%, that'll put us at levels that we've not seen since December 2008. That is 1 year and 9 months high. We want to see UK CPI above 3.7%. Walk away from next month's CPI number to know for sure. But it's encouraging to see that consumer prices are not wavering. Now, getting back to our points, we ask ourselves a question, even though the Bank of England has not raised rates so far, the question is, when will they raise rates? If we continue to see growth in the consumer price index, in the unemployment levels, let's take a look at unemployment, by the way. Unemployment, what's unemployment in the U.S.? 9.6%. Unemployment in the UK, 7.9%. Kicking to the downside after hitting highs to 8%. Wish we had 7.9% in the U.S. That would be an improvement from what we've seen here. Unemployment's not as bad as it is in the U.S. The last numbers I remember, I believe, Eurozone unemployment is around 10%. So UK beats the US and the Eurozone in unemployment numbers. I don't personally track UK GDP numbers. I would guess that they probably look better than the US numbers, probably better than the Euro numbers as well. That's why I think that the Bank of England probably will raise rates sooner. Well, if I'm so bullish in that, why would I not want to buy a pound? Because a pound dollar, because let's go to the pound dollar chart, by the way. By the way, if there's any specific currency pairs or economies that you want to discuss, please don't hesitate to let me know. I'm going to try to cover, I think, what's most relevant. Here's a pound dollar daily chart at 154.12. Why do I not want to buy a pound dollar yet? Because this is a bearish chart. We see the semblance of what could be a head and shoulders pattern. Take a look at the highs. 154.70, those are highs of July 15th. 154.70. Kind of looks like a head and shoulders pattern. It's not as clear cut. 67.70, there we go. Not as clear cut as the Dow Jones Industrial Average head and shoulders pattern, but it does show us that we made higher highs and now we're not making higher highs. We made higher lows and now we are not making higher lows. In fact, we could furthermore draw a downtrending resistance to capture the most recent data, and it shows us things do not look good. I like to make a trade based on fundamental data that makes sense, but also when the charts agree. Pound dollar fundamentally tells me, yeah, I want to buy the pound dollar because I think the Bank of England is going to raise rates before the U.S. However, the chart tells me not yet. We're still buying dollars as a flight to safety as opposed to the pound because the Bank of England can still cut rates a little bit more than the U.S. The question is, from where do you get the data resources for your statistics in Excel? I wish I could give you a simple answer. It requires a lot of research. I've spent, I don't know how many hours. If you go on Google.com and you type in U.S. Consumer Price Index historical data, UK unemployment data, historical data. You can go to Yahoo Finance. They have some historical data there, more along the lines of the actual, the Dow and the DAX and the CAC, the actual market. It just takes a lot of looking. The sources that are found that tend to work better than the others, if you go to each respective central bank website, the Federal Open Market Committee in the U.S., the FOMC, I think it's .gov. I don't know. It's very easy to find if you go on Google. Google Bank of England, European Central Bank, Reserve Bank of Australia, etc. And from that point, some of those websites will give you the historical data. It's actually a lot more difficult than you think because it's so spread out and not all the data is put in the same format. Sometimes they'll give you daily chart data, weekly, monthly, quarterly, biannual, annual, etc. At the end of my webinar, please remind me if I forget, but I'll give everyone the address to my website. I have all this Excel data put together on our website as well. We made a bunch of movies that explain it. Remind me at the end of the webinar, I'll give everyone the address. Getting back to the pound dollar chart, it's not good. It's not good so far. 154.70 was the high that we were able to achieve going back to July 15th. It's not a perfect, very clean head and shoulders. One could argue, well, there's another head and shoulders up here, 157.00. We can draw our Fibonacci lines from the highs down to our most recent swing lows. seems to frame the market in pretty well with a 38.2% Fibonacci retracement level 155.65. That looks like it appears to be resistance. Either way, because it's not easy to exactly identify where we are, we cannot avoid, or we cannot ignore these trend lines. The uptrending channel, which has been broken, and the downtrending channel, which has emerged. Zooming out a little bit on the pound dollar daily chart. Now, if you draw your Fibonacci lines from the bottom on up, you might ask, well, how far down could the pound go? I don't think the pound dollar is going to make new fresh lows. I don't think so. I think we're going to fall back to a Fibonacci retracement level. It could be here. I mean, after all, take a look at the lows, excluding that one long candlestick wick at 153.43. That was on September 8th. The market so far has held above the 38.2% Fibonacci retracement level. One might want to buy it here based on the theory that we will not break below the 38.2% level. There's a lot of uncertainty though. And the only reason I think why the pound's on a weekly, by the way, if you've noticed, I think one of the only reasons why the pound dollar currency pair has not broken down further is simply because the dollar has been so incredibly weak. Again, markets, when we go through these periods of pessimism in the market, we know the market tends to buy those low yielding currencies like the Swissy and the yen and the dollar. But the foreign exchange market, if you've noticed, has really ignored the dollar, meaning the dollar's at lows. We don't have to go any further than the daily chart of the dollar Swissy. I'll refresh the chart here. Dollar Swissy, 1.0034. We hit lows today of 99.95 below parity. Parity is when $1 equals 1 Swiss franc. When was the last time the dollar was below parity against the Swiss franc? We have to go back to 99.60 lows. That was in December of 2009. 9 months ago, the dollar has not been in new lows. By the way, on the monthly chart, it's very, very clear that we are making lower lows very predictably, lower highs, I should say, and we are making higher lows, but today's candlestick, really today, seems like every time I have a webinar, we have a very big move, a very important move. Today's candlestick is threatening to break this trend line going back to March of 2008. The next big low is 99.14. Those are the lows of November of 2009. That is only about 100 some odd pips away. If we break below 9,900, then the next lows is 96.48 March of 2008. Zooming out on the monthly chart, if we break below 9,600, look out. We have not seen lower lows. My charts go back to 1988, and I'm guessing a lot further than that. So if the dollar Swissy is below parity, we were slightly below parity a little bit earlier today. It's certainly foreseeable if you go back below again, the trend is a friend. We could go a lot lower. Dollar yen, similar story. 83.24 hitting lows of 83.07. Monthly chart tells us the last time we were in the 8,300 level was 1995. 25 years? How long ago? 2010? A long time ago. 15-year lows on the dollar yen. That is because despite strong stock markets, and I really would exercise a great deal of caution, the stock market sometimes, meaning the Dow Jones, the S&P, the Russell, the DAX, the CAC, the Nikkei, etc., they seem to be a lot of times the last markets that really wake up and, smell the coffee and understand what's going on. Stock markets, a lot of times, especially in quiet months like August, in the beginning of September, which we're still kind of in, stock markets, in my experience, ignore news. Bad numbers, stock markets go up. Good numbers, stock markets go down. There's no rationale behind it. The stock market is a very finite amount of buyers and sellers. Not to say it doesn't mean anything. I don't want to short the market if it's going up, but sometimes it's not going to make sense. And I think the stock market starts to make a lot more sense when we have more volume. October, earnings season, we expect a lot more volume. I think it'll begin to make a lot more sense. But so far, the U.S. dollar, the foreign exchange market is telling us that the U.S. dollar is at 1995 lows against the yen, very close, about 100 pips away from more than 1 year lows against the Swissy, a few hundred pips away lows away from multi-decade lows against the Swissy, or against, the Swissy. We are in trouble in terms of the dollar, and I think it's just a matter of time before the stock markets kind of wake up and smell the coffee. Now, let's get to some other charts. Oh, I want to show you something really, really neat looking. And stock markets, they are not all equal. This is a chart that I like to keep as well. If you take each respective currency that we normally follow, the euro, the pound, the Swiss, the Aussie, etc., take each respective stock market, put it all together on an equal scale, this is what it would look like. We have a color code key at the bottom, by the way. The dark blue line, the Dow Jones Industrial Average, the DAX in Germany, FTSE in the UK, CAC in France. The ASX 200 is the Australian index, NZGI in New Zealand, TSX, Toronto Stock Exchange, SMI, that's the Swiss market, and the Nikkei 225 average in Japan. Specifically, and we can see there's a very close correlation. I mean, what's good, and it's actually kind of comforting, when we in the U.S. go through bad times, everyone else kind of goes through bad times also. When we go through good times, everybody else sort of enjoys the profit together. On a major macroeconomic global scale, that this holds true. Now, there are times that Japan is a recession and the U.S. is not, and Europe is in trouble and the UK is not. Those are the little variances, but there are good cycles and bad cycles. I mean, after all, take a look at the highs. The Nikkei hit that really, really big high of 2007. The Toronto Stock Exchange did not hit highs in May 2008. Well, oil was really high, so maybe that helped out Toronto a little bit. We hit those very, very big lows going back to 2001, 2, and 3. Before that, we hit very big highs, 2000. In the year 2000, all stock markets did well. In the years 2002 and 3, all stock markets did very poorly. So far, we've seen all markets kind of bounce off the bottom, but we'll notice what has happened. And this, by the way, I'll preface all this. I update this Excel data on a monthly basis. So this is taken as of monthly closes. So September 1st was the last time I updated this data. Take a look at what's happened. As of September 1st, or August 31st, the TSX, the Toronto Stock Exchange, was 11,913 closing price. Not very far away from April of this year highs, and not very far away from highs going back to September of 2008. So Toronto Stock Exchange really is performing relatively very nicely. The dark blue lines, the Dow Jones Industrial Average, we know we're about 1,000, 1,200 points off of its high. The dark blue line, the SMI, that's the Swiss market index. I think that's what it stands for. The DAX, these markets are more or less not too far from the highs, with the exception of the Nikkei. The Nikkei closed August 31st at 88.24. After hitting highs of 11,089. That's literally 3,000. Am I doing my math right? Lows of 88. That's almost 2,300 points off the high. But just on a relative basis, we can see the Nikkei has come down a lot further, faster than the other stock markets. Why is this important? The Nikkei hit its high June of 2007. The Dow Jones Industrial Average hit its high September of 2007. The TSX Toronto Stock Exchange hit its high May of 2008. Some of these markets, the SMI that's the DAX, that's in Germany, hit its high December of 2007. For some reason, at least over the past couple of years, it seems that the Nikkei hits tops and then turns back to the downside. We all hit the bottom basically together, but it seems that the Nikkei turns to the downside faster than other stock markets. Not an exact science. However, making an educated guess that the Nikkei might be a little bit of a forward-looking mechanism, a little bit of a leading indicator. The Nikkei has broken down the levels that we've not seen since April of 2009. Dow has not. Toronto Stock Exchange definitely has not. Most of these other markets certainly have not. The Nikkei has really spilled to the downside, and if anybody knows what the Nikkei is now, my closing price as of August 31st is 88.24. Let me take a quick shot at Bloomberg to see what they say. 88.24, and the Bloomberg.com tells us the Nikkei at 92.99. We've recovered a little bit since then. The other thing is that I would not expect huge moves until we see volatility return to the markets. I spoke about this chart last, and I'll give everyone the link. This is an indicator, a fundamental / technical indicator called the VIX, Volatility Index. Basically, it measures the relative basis of volatility in the options that are traded on the S&P 500. During volatile markets, the VIX goes to highs near 40 level. If you see the VIX near 40, it means the market has been moving very fast and has a probability to turn to the downside. When the VIX comes down near the 20 level, it means markets are very quiet and we expect volatility to increase. Well, we did see pretty significant highs back in July earnings season. Before that, May, before June, we saw very significant highs in the VIX. Right now, the VIX is still relatively quiet. We're at 21, I believe. Zooming out to a 5-year chart on the VIX gives us a little bit more perspective. What we saw in the end of 2008, I don't think we will see again for a very, very long time. That's when the VIX hit that 70 level. And as far back as my charts go, I have not seen the VIX make higher highs since then. I cannot believe that the VIX has been higher. Maybe 1987, maybe 1929, but not in recent history. Point being though, the VIX has hit very, very big lows. And when the VIX hits lows, we say, well, the market is very quiet. We're not buying a lot of calls. We're not buying a lot of puts. Therefore, we don't expect the market to move very much. And that is typically the time that the market really starts to move. Coincidentally, I don't like to believe in coincidences in the stock market, but coincidentally, we're coming into October earnings season. Again, I expect this to be a pretty interesting next couple months. Earnings season and elections. Let's get back to the charts. If there's any currency pair again that you'd like to see, please do not let me know. Please do let me know, I should say. Compare the euro-dollar currency pair, 128.54. We just hit a double top high near 129. Kind of looks like a head and shoulders too. Not too far. How much are we off the highs? How much, going back, how high is high? Well, take the highs of August of this past year. The euro-dollar hit 133. Remember, the ZU number, the German investor confidence number, hit 19-month lows. Is the euro-dollar ready to hit 19-month lows? Well, probably not. Not against the dollar, because the dollar is just so unbelievably weak. In fact, 128 to 133, we're only about 1,500 pips off the high, going back to highest since May of this year. Compare and contrast the euro-dollar to the euro-yen. 107.04. Are we close to those one-year highs? Absolutely not. 126 down to 107. We're 2,000 plus pips off those highs. And in fact, euro-yen, 105.42 are very big lows. We're at 107.02. That means we're 160 pips off of, go to a monthly charts, 160 pips off of lows we have not seen since November of 2001. That, ladies and gentlemen, shows us the difference in strength between the euro-dollar and the euro-yen. Buying the euro-dollar and buying the euro-yen is not the same thing anymore. Once upon a time, when we sold short those low-yielding currencies and we had good numbers in Europe, it was, but it's not the case. Remember the pound-dollar? 154.14. What are the lows? The big lows, 142. That's 1,200. No, yeah, 1,200 pips. 1,145. Yeah, 1,200 pips off of the lows going back to mid this year, and those are very, very big lows. Cable yen at 128.35. 126.71 with the lows. 200, less than 200 pips off of those lows. 1,200 versus 200. The yen is much, much stronger. Coming into October earnings season, we expect the market, obviously, for the volume to increase and trends to develop. So construct a currency pair, and I think this is really the point I've been struggling to make over the past 40 minutes or so, that when we try to discover the best currency pair to trade, there are two currencies within the pair, we should try to build a currency pair based on as much fundamental data as possible, having the technical data reinforce and agree and give us confirmation on our fundamental research. Once upon a time, I was a pure market technician. I, pointing figure charts, Fibonacci, Elliott wave, any which way you could look at a chart, I threw myself into it, sort of ignoring fundamental data because I would say, well, who's the Federal Reserve, who's the Treasury to say that unemployment is at 9.6% and non-farm payroll came in at this number, because they always revise the number. And how can I really trust them? And how do I know what that means? But I've gone through really a drastic change over the past, couple months and couple of years. Not that I put that much more credence in the fundamental data, but the fundamental data that we have that we can, judge on its own face value, it does show us what employment is, consumer prices, what they are, gross domestic product, etc. And using that fundamental data that we have at our resources, and everything for me came together when I started to collect this data on Excel. And I was really able to compare and contrast the three different markets against the number together. If we see that the fundamental data in the U.S. is so much worse than it is in the U.K., and the U.K. data is still, I would argue, better than it is in the Eurozone, my fundamental opinion is, just as an example, I think the Bank of England is going to raise rates before the European Central Bank. And if I'm right, then I would expect to see the pound get stronger sooner than the dollar, sooner than the euro. Therefore, I would expect euro pound to go down. Fundamentally, I'd expect pound dollar to go up, and eventually pound yen to go up, and therefore I think it's a better buy to buy pound dollar because the dollar as opposed to pound yen, because the dollar, we are just selling the dollar and selling the dollar, and if stock markets go down, we're going to buy the yen again as a flight to safety, but we're not going to buy the dollar. Remember the dollar yen charts. Both of these currencies, this really tells a story. The story inside the story. Both currencies, the dollar and the yen, tell us, both those currencies are currencies that we buy when we say, we're in trouble. But based on the fact that the dollar yen is at 1995 lows, and you could even say the dollar against the Swissy, remember the Swissy is that other component that would buy as a flight to safety. Even though we buy both those currencies when we say, we're in trouble, the dollar Swissy is few hundred pips away from multi-decade, 20, 30, 50-year lows. That means that despite the fact that the dollar has low rates, because the data in the U.S. is so poor, we don't want to buy the dollar because there's really not a very, very good chance that the Federal Reserve is going to raise rates anytime soon. And on the con, we could say, well, the Bank of Japan's not going to raise rates soon. True. Swiss National Bank, I don't think they're going to raise rates soon either. But the difference is, because of the U.S. Administration, kind of to agree with what Ed Ponzi was saying about 45 minutes ago, because of the enormous amount of spending and stimulus measures that the current administration in the U.S. has enacted, every time a new stimulus plan is put into place, that is dilutive. When the Treasury has to print now many more billions and trillions and zillions of dollars, every dollar that we have is worth a little bit less. And if it's worth a little bit less, it means it's going to go down against the euro and it's going to go down against the pound. I don't want to interject my own political opinion, but just as a pure market analyst, what the administration, I think, is doing right now, I think we can see very, very clearly in the charts. In other words, I think the charts agree with me. That the dollar is going down faster than the yen is, faster than the Swissy is, and faster than most of the other currencies. So, construct a currency pair on a currency that represents an economy that either already has high rates and you think that, or you think that they will start to raise rates in the near-term future. Put that winning currency against a currency that I don't think they're going to raise rates anytime soon. Bank of Japan, Swiss, maybe, yeah. Dollar, definitely. So put those two currencies together from a fundamental opinion, and I think you're going to find a very, very fast-moving currency pair. And that's really, I think, when foreign exchange traders, they make their bread and butter, is in these fast trends. We have not made a lot so far let's find a good example. Well, the euro dollar is always, let's find a better example. Euro yen's a good example. Lately, euro yen has not done very much. 107.08. Euro's been weak. Yen's been weak. Euro's been strong. Yen's been strong. Kind of moving together. But all of a sudden, when we had these very, very quiet markets, you take a look at back to May 5th. Euro yen hit highs of 123. May 6th, we hit lows of 110. In fact, May 6th, we hit highs of 120. That was that very big 1,000 point move. But a trend did develop. And we can zoom out and see other trends that did develop. Take a look at the euro yen. January 10th, we hit highs 133. January 10th to February 4th, 4 weeks later, 121. What did I say? 133 to 121, 1,400 pips in 1 month. And I'm guessing, I don't remember exactly the timeline. I'm guessing that we were right in the midst of the Greek debt crisis around that time. And I don't think we're quite out of the woods in the Eurozone yet, especially considering today's Zoom number out of Germany. So, out of quiet markets, all of a sudden develop very, very fast markets. And before you know it, the markets move 100, 500, 1,000 pips and say, wow, if I could have just caught that. But we can't catch that. And I'm equally optimistic as Ed Ponzi is that anyone can make money in the foreign exchange market. You know, it takes a lot of work, a lot of research, a lot of patience, a little bit of luck sometimes. But I think that the preparation really is something that we can do as much as we can. The power's in our hands, so to speak. If we prepare moving forward, how do we prepare? Start taking a look at fundamental data. See what the U.S. retail sales were in comparison to, you know, where they have been. Today's number was a little bit of an improvement. I'm not thoroughly convinced it's a fantastic number. It was just 0.1 of a percentage point better than expected, I think. 10 basis points better. So not tremendously good, but you put these different economies and their different fundamental numbers together, and you'll begin to be able to form an opinion. Will the Reserve Bank of New Zealand raise rates a little bit later on today? Will the Reserve Bank of Australia raise rates anytime soon? So far, they've paused like 3 months in a row. And, you know, we don't have to be right all the time, because one time that we are right, putting a strong currency against a weak currency, there's a very good chance to catch one of these just tremendously, tremendously fast-moving markets. With that said, by the way, I'm out of time. However, if you want to contact me, and by the way, if you're interested in some of that Excel data, made a bunch of movies that sort of explain all that, go to the website www.forex.com. On the forum, by the way, go to the forum, and this is the address of the forum. It's com/forum. Go there, free forum, register, and inside the forum, we talk all about that Excel data and much, much more as well. Please see FX Street's calendar, because I'll be back on with some really great stuff later on this month. I want to thank FX Street. I want to thank everyone for joining us. Wish you all a great day, all profitable trades. And we look forward to seeing you back soon.